right, welcome to the Happy Hour Money Podcast. Thanks again for joining us. Cheers. We are actually recording this super early in the morning, so we are not...
Coffee, no booze.
Yeah, coffee, no booze. Well, there might be a little bit of Irish coffee in here, but nonetheless, cheers, and hopefully you're watching this while enjoying a nice beverage. But today we're going to talk about a relatively depressing topic, so that's should definitely hope you have your adult beverage to get you through this one. But we're going to be talking about inflation. It's obviously been a hot trending topic, just with everybody concerned about going to the grocery store, gas prices, everything that's going on currently as of the recording of this video. And frankly, we don't see sort of an end on the horizon, and that's one of the things we're going to be talking about is what is inflation, how it's going to impact you, how it can impact your investments, how it can impact your ability to retire, or as we call it, get to work optional. So we're going to be really diving in deep, right, Isaiah?
Yeah, and I would say, I think first and foremost, like just a good definition of inflation. And so inflation is going to be a general progressive, and I think progressive is a key thing there, right? Like how quickly does it happen? Increase in the price of goods and services in an economy. And the other thing is that inflation corresponds to a reduction in the purchasing power of money. And again, you're going to hear that kind of concept come through. And the other key thing that we've heard is, you heard from various different leaders, we won't necessarily call them out here, but it was, hey, we're going to be patient, expect to wait and see, not react too much. It's going to be small, likely inflation will be transitory, right? Like this idea of transitory. And then, so that was January 2021. If you go to November of 2021, I know you believe this is transitory, but everything is transitory. Life is transitory. And then it became, JPAL 2021. It's probably a good time to retire the word. So within an 11-month period, it went from this is just going to be a short blip to maybe we should just not use that word anymore. And then you started to see inflation really start to ramp up pre anything with Russia and Ukraine. And then all of a sudden it was, a Putin issue. And it was like, well, no. We were actually at a 40-year high prior to all that crap starting. So this has been something that it's been interesting where it's turned into inflation being kind of a little bit of a blame game. But that aside, political affiliations aside, wouldn't matter who's in office. Doesn't matter. It's not a Republican or a Democrat thing. Like inflation is a systematic issue that I think we're going to run into. Yeah. And so for us, it's like, how do you start to unpack that and think through it? And so just the idea of understanding what inflation is, and everyone's inflation rate is going to be different. Josh, if you're looking to buy a house, and I already have my house, our inflation rates are totally different right now. So I think that is kind of where we can probably jump off from and go through things.
Yeah, and I think that's, you brought up two valid points there where it's like, I think two big misconceptions with inflation is one, that it's a political thing. It is absolutely not a political thing. It's a bad economics, good economics thing, and everything in between. And in addition to that, it's also relative. Obviously there's direct cost of the single good, but wealthy are going to be impacted differently than poor people will be impacted. People that live in California are going to be impacted differently than people that live in Idaho. So everything with inflation is very relative to you personally. Everyone tries to put this nice bow on it of like, oh yeah, it's exactly 7.6% inflation, which even that number, as I'm sure we'll talk about during this, has changed over time. And so again, it's just very relative to the situation, to the politics of the time, all these different things. But yeah, and I think even pulling back, one of the things I was going to mention on the kind of definition of inflation is a lot of people have kind of trouble grasping, the term like loss of purchasing power, right? I think the best analogy I've ever come up with is, just remember your grandparents being like, hey, back in my day, Coke was 25 cents or 5 cents or whatever. Well, that's inflation. Now that it's like $3.50 or something ridiculous like that now for the same exact Coca-Cola, that's inflation. So where your dollar just doesn't purchase as much, even though it's the same good.
Or it can be the same good and the ingredients inside of it are very different, where they're substituting things out, where it's trying to hold the same dollar amount so people don't feel it when they go to the grocery store. Or it's like that shrinkflation where the bag of chips was this ounce, right? And now it's less, or it's got a little bit more air. And there's all these games that are played, and it's like, that's how you can hide inflation. And
yeah, sorry to interrupt real quick, but I got a funny anecdote. I was trying to explain shrinkflation to my wife, and she just wasn't understanding the concept because she's not a finance person. But we were I kept explaining like, oh yeah, Costco's doing shrinkflation. Like the numbers are staying the same. Like, okay, the bag of chips is still $3, but you're just getting less for that $3. And she was like, I kind of get it, but I don't understand how that, like the impact type thing. It's like, it's inflation just being disguised, right? But then she ordered dog bones randomly. Same dog bones we'd ordered for 10 years, and or not 10 years, but they were like half the size, and just seeing like they used to be huge, and seeing them drop down to like basically like barely nibbles. And she was like, I get it now. This is the same exact price, everything.
Well, and it's the same thing. I mean, like you think about a restaurant, like your favorite restaurant you go to, right? They've obviously been pinched with COVID and all these other challenges of changing things, finding people to show up to work. And now it's like soaring food prices. So they see inflation, they say, okay, we're either going to, run this the same way that we have in the past, and we're just going to increase prices, high quality, or we can start diluting things, maybe buy from a different vendor, or cook with different materials and start to try to lessen the quality of the food,
or do layoffs to staff.
And so it's just it's a really troubling topic, and one of the things that frankly pisses me off, and I'm not going to call out who it is, but if we scroll back through Twitter and the timelines, there was an individual that is a fairly, I would say, well-known advisor out there that wrote this like 7 pieces of why inflation was good for people. And I basically said that's absolute bullshit in there, that if you own every asset that you ever wanted to own, inflation could be fine. Yeah. But if you have anyone that wants to accumulate any more, inflation is not necessarily good. And the fact that it disproportionately impacts people on a that make less, that are more, hey, it is paycheck to paycheck, or there's a little bit of margin, but not much, because there's no margin anymore for those people. And we'll talk a little bit about, I think the 2 biggest, drivers that people have seen is, gas prices and food. And those 2 things impact every single person. And when you start to see those numbers the way that they are, it gets really, really difficult. And so I pulled some different pieces together, but if you look at, as of real recently, again, this is always going to be changing, but the national average for fuel is over $5 a gallon, and that is significantly higher than it was a year before. That's 63% increase according to AAA. And California, when we were talking about them a little bit, they'll probably see $10 gas, which was a joke at some point. They're like, oh, there's no way it'll get there, and it's like, well, absolutely it will. The other thing that has been really interesting in this like higher inflationary environment with energy is the idea that people don't want fossil fuel, or this ESG narrative that, again, we'll try to stay away from that a little bit. We'll say it for another podcast, but it's really interesting in California because they have a lot of natural resources that they won't actually allow them to extract out of the ground, even if it's way away from others where it could actually bring down those prices. Instead, they'd much rather bring it in from Ecuador, ship it in, have these huge ships bring it in, because that's much more efficient than just going and getting it out of your backyard, basically. But CPI through May, energy was up 30% year over year, food was up 9.4. And if you break that down, like we talked about, CPI has changed so much in just the way that it's calculated, because they'll sub things out, they'll adjust it, and there's always this game of like, well, we'll just substitute it. Instead of, hey, you like steak, well, now you're going to eat ground beef. And they'll say, hey, inflation is still this number. It's like, well, you took something that was high quality, you replaced it with something that, hey, you can still get good ground beef, right? If it's grass fed, all that other stuff, but it's like, that's not the same cut of meat. So like, how are you saying that is, something that someone's just going to switch to? It's like, that still is the price of things going up. So the idea that inflation is, going to be transitory or change, Starbucks has raised prices 3 times since October of 2021. If coffee prices come down, Starbucks is not all of a sudden going to say, hey, Josh, your latte is now less. No, they're going to keep that margin for themselves because they're a business and they're going to try to run it to where they maximize profitability. So it is like a stair step up. And unless we get into this like deflationary, like massive reset, prices aren't coming down. Like, it is a permanent increase. And I think that's what people start to see.
Yeah, absolutely agreed. And it's one of those things that people will, I think, begin to see it more and more and more, just because it is happening so quickly. Like you mentioned earlier, that inflation tends to be progressive, which right now I'd say we're not necessarily in progressive inflation. And I don't have the exact stats in front of me, but like alluding to kind of the measures of CPI and how that's not necessarily an accurate measure. Well, like, so CPI has actually, which is Consumer Price Index for those that don't know, it's just how baskets of goods are measured to try to track inflation, which, when there's millions of goods out there, obviously it's a hard task. So, we can blame Fed and all these things on, that's not accurate, right? But they have a very hard task getting it accurate. But that being said, because it is impossible to really get to an accurate standpoint, it's really subject to the politics of the day, and everyone wants to look good at their job. And like CPI back in the 80s was measured very differently than it is today. And back in the 80s, it I think was a much more realistic look at where inflation actually was, all things considered. And if we measure inflation exactly the same way as we did then, well, inflation right now is closer to 15+%, which is double about what the Federal Reserve is quoting it is. So that's again why we're saying take all these things with a grain of salt. But also I think area worth talking about too is that inflation is not always just in terms of price of goods. It can also be in just lifestyle expenses. For example, one of the things that we've seen over the past year, and as we speak right now, Texas is getting hit hard by this, is because of asset inflation. Housing prices going up because there's just so much money in the system. Well, Texas did a reset of their property taxes based on the new valuations, and we saw inflation of taxes by like 150% for some people in Texas, which is
wild.
Yeah, which is insane. And that happened literally at just with one letter, all of a sudden 150% inflation. It's like not very progressive. So it's just a very interesting time. But with that, I think kind of pulling away from kind of what is inflation and where we're at with like just the current environment. Let's dive into like kind of the functions of inflation. Like what causes inflation? What are the variables we're seeing today that are causing inflation? As we mentioned earlier, it hasn't been necessarily transitory, which we never thought it would be. We actually recorded a webinar probably 2 years ago.
Yeah, January 2021, we talked about inflation.
Yeah, preaching that this was going to happen.
And it's hard to like make predictions and be right, and prediction games are tricky, and it's I guess fun or nice when you're like, hey, the thesis was right, but shoot, the things we talked about in that conversation have come to fruition like a lot. So
well, and for us at the time, it seemed so obvious that it wasn't going to be transitory, which I think that's part of what I think it's worth talking about, how some of the mechanics work and kind of looking at why we think inflation is going to continue and where we think it's going to go, and some of the variables that are going to keep it that way. So like, I guess talking into just where we were in 2021, kind of why we came to that conclusion then, and sort of fast forwarding to where we are today, coming out of COVID, two of the main factors that go into inflation, and there's actually an equation that goes into this, which is basically, the amount of money in the system and the velocity of the money in the system, that equals inflation, right? Well, money in the system, that's easy to track, and during COVID, this is the part that scared us the most, was that, $7-8 trillion was just dumped into.
It made the great financial crisis bailout look very, very small.
Yeah. And like trillions of dollars is hard to put into context, but like $1 trillion of like dollar bill or like $100 bills could fill.
It's like NFL stadiums and stuff. It gets silly.
Yeah. The amount of money it is unfathomable for like our mind to comprehend. But so that's one of the things that scared us, was just how much money was dumping into the system. But the justification there was like, hey, the velocity, or how quickly money is changing hands, that's the other aspect, but velocity was very low. So the Fed and a lot of the pundits out there were saying, no, well, velocity is low, we're not going to see inflation, and velocity stayed low for a while.
2008 it didn't happen, so it won't happen this time.
Yeah.
I heard that a lot. Yeah. Like, hey, we printed a bunch of money then, we saw things, and we didn't see inflation.
Yeah, and
but it's measuring what inflation, asset prices, like the stock market, still counts as inflation. I think that's the tricky part.
Yeah, and that's going back to some of the fallacies of CPI, right, which doesn't track asset inflation. But with that, one of the things that we talked about was like, okay, well, velocity is low today, but we're sitting in the middle of a pandemic where people are basically buried in their basement, not socializing, not spending money. I mean, they're spending some money online shopping and stuff because they're bored.
Yeah.
But they're not going to restaurants.
Dollars are way up.
Yeah, they're not. Yeah, but they're not going to restaurants. They're not doing a lot of the just normal
travel, vacations.
Yeah, all the normal life things, and those are the things that typically cause faster velocity. Just because the as bad as this may be to say, the lower class, like, kind of in terms of wealth class, tend to spend money faster. And a lot of the company, like businesses that were impacted by COVID, restaurants and things like that, and tourism, those are some of the highest employers of lower class wealth wise. And so they weren't spending the money because they didn't have money to spend.
Yep. Furloughed on unemployment, they were just saying, hey, we got to pay our rent, we got to eat our food, all that stuff. And it wasn't going to other things. Yeah,
but for us, it was like, okay, we obviously see like velocity is not going to stay low. So you add in all the money going up.
Yep.
Eventually that velocity piece is going to take up, and next thing you know, boom, inflation.
Well,
and it seems so obvious to us.
Yeah, but marry that with a lot of, you think about COVID shutting down, and whether it was China or other ports, people not being able to move goods anymore and shutting off manufacturing capacity across the board for a lot of different goods, and then people started to order it, and then that continues to tick. And unlike a light switch, which, again, going back to not criticizing Republican or Democrat, but leaders in office seem to think like you can flip things on and off. They don't understand that there's a lag, and the lags are like years for things to get moving. And so you can't just turn it off and turn it back on. And so then you all of a sudden see supply chain issues. And that's when you see used cars go up 35%. That's when you see people not being able to get things done. I had a client that got in a vehicle accident, right? Truck totally repaired, but they're gonna have to probably total it. And this has been 6 months now because they can't get seatbelts.
Yeah.
Vehicle's fine, can't get seatbelts. So you can't obviously put that back on the road. And the insurance company's like, well, we're gonna have to total this, $75,000 truck because we literally can't get seatbelts.
Well, I'm a diehard Ford Bronco fan, as you know, and I've been on the wait list for the new Bronco for 2+ years at this point, just because they couldn't get they started with the chip manufacturing issues during COVID, and then, has since been other kind of just supply chain issues. But yeah, I mean, that's like insane. Like where some, back in the day, I'm sure they could produce that car in 6 months, from very beginning order to even like right away, but and get it to like the full completion. And so it's just kind of crazy when you're actually seeing some of these things play out in real life. And yeah, to your point, I've seen several clients that have been unfortunately in car wrecks, and they're, I was actually talking to a client yesterday that was saying, yeah, she had her like Porsche just like was parked in LA and got just beat up by some angry citizen, I guess. And now she's like, well, it's a Porsche. Can't get any of they're hard to get the parts anyways. Not in the pandemic. Now it's like, she's like, I don't have a car. Can't go do anything. And I was like, that sucks.
And again, this is getting off on a little bit of a tangent, but there's a great book about the power of deflation that Jeff Booth, who is a serial like tech entrepreneur, and he's had some really good quotes around, the kind of this wealth disparity and why deflation like is a key to an abundant future. It's fantastic read, great book, awesome, really intellectual guy that I think speaks very eloquently about a lot of different topics and gets it. But he's talked about you can't build walls high enough, right? Like even if you're massively wealthy, so you have a Porsche, you have all the stuff, if everything crushes the vast majority of people, it doesn't work. Mm-hmm. And so like you have to solve this. And I think that's a little bit of what's trying to go on right now, where from the Federal Reserve, again, we can criticize Jay Powell and Yellen and Biden and all these people, right? But they were kind of giving us a shit sandwich to start with. It wouldn't matter who was there. Yeah. Like, right? I would want that job. There's no solution.
And yeah, to that point, I mean, I personally think this has been a problem that has been building since 1995, basically. Like I think even the original tech bubble was partially just due to Fed trying to get creative and all these things just over decades. And now we're seeing because they basically didn't want to allow a market to crash, and start doing all these creative.
If you cut interest rates and flood the money into the system every time, and instead of letting it kind of, like the forest fire analogy, burn and then the regrowth, but you're just trying to put out all the fires all the time, and so it just keeps building and building and building until you just get something that just ravages through.
Yep. Economies, like everything, every ecosystem have cycles, and you need to let those cycles happen naturally. I mean, we're seeing actually, along the fire analogy, we're seeing that happen in real life with fires in California right now, where they didn't let the system just do what it was supposed to do, and now prolific fires are happening all the time, and they're getting more and more devastating. Where
in Mexico, right? Isn't Baja like on the coast, like underneath San Francisco? I don't know my geography of over by California.
What is it? Way under San Francisco. Way under San Diego.
Oh, San Diego. Sorry, yeah. That's what I meant. I meant San Diego. That's what I was thinking. But Mexico on their side, they basically let forest fires burn, and so they don't have as many issues. But then just above the border on the United States side, like they have tons of issues with what you're just saying of like just the way that they manage it. Now there might be a lot of other reasons why they manage it a certain way, but I think that is kind of an interesting analogy back to markets.
But it's same way here. If you let the markets naturally correct and have been doing that for the past 20, 30 years, well, then we'd be in a much healthier system today, where basically what's happened is we've tried to essentially soften the blow along the way, which is just kick the can down the road. So eventually, bending becomes breaking, and that's what we're seeing today.
In an area of continuing, to lower and lower interest rates, it's been easier for those that, again, have assets, are able to borrow at cheaper rates, deploy and get more assets and like play that game. And then all of a sudden you're starting to see, with interest rates rising and inflation higher, like some of those things start to correct. And I think it was Lynn Alden that did a really good piece. She writes tons of great content, but it was showing basically in periods of higher inflation, you see the wealth disparity actually start to, it's like higher inflation and then I think rising interest rates. It was a combination of, I think, the two of those, but it basically showed the wealth disparity starting to narrow a little bit, like over time historically when you've seen that. But the other thing, going back to kind of inventory and stockpiles and different things, like what we're starting to see too is like big retailers. So Target, Walmart, all these different, kind of big box stores, they've had, quarterly reports over the past, I think the most recent quarter, they've had, drawdowns in their stock price as high 1 day losses since '87. Like it was massive intraday moves. And one of the big things that was happening is they saw a 26% increase in inventories. And so for a lot of those stores, they have to sell that stuff quick because, right, it's seasonal. And then you're going to be sitting on it and you're going to discount it. And so those names, and I think even Target's CEO came out and then was talking about how much, they're going to make changes and do all these different things. And the COO talked about $1 billion fuel surcharge. And it's like that eventually, they're only going to absorb so much. That gets passed on. And then that goes back to kind of the inflation piece, where there is a significant issue with just the cost of energy for things to get around, where we've been very spoiled for a long time, where, hey, this just-in-time inventory, all of a sudden inventory is not a liability, it's been an asset, but then you're getting punished for it because people are still using this older playbook. So it's an interesting place to be for a lot of different businesses at the moment.
Very. And actually, I think before we dive into kind of where we're going from here along that lines, I think there's an interesting side anecdote here where, history does not repeat itself, but it rhymes, as we like to. I forget who originally said that, but yeah. we use that quote a lot. Where if you look back through histories of massive corrections, well, the one that touches everybody's mind is the stock market crash that caused the Great Depression, because of an equally imbalanced system back then. Well, the two main triggers, or I guess three main triggers of the Great Depression were, one, super high asset values from the Roaring '20s, which we look right now, we have super high asset values. Granted, they've pulled back since the very top, but they still got a long, still are way overvalued even after the drop. Then number two was massive leverage, because of just people speculating, things like that. Well, we have massive leverage on the corporate level. We have massive leverage now on the personal level, and just on the investment level, like people
and sovereign. So like just governments. Yeah. So I mean, a lot of the debt has been corporate and government. Consumers a little bit better, but I saw like the piece on credit cards is massively exploded with inflation, because people are basically trying to like
make ends meet.
Yeah, make ends meet and hope they can kick it down the road long enough. But there's going to be some reckoning at some point.
Yep. But the third one that I think is very interesting, especially right now with all of the Targets of the world, now updating the public on these disclosures, is because the original worry was that hey, there's not going to be enough inventory because of the COVID lockdowns. But the third piece that was the straw that broke the camel's back with the Great Depression was overstockpile of inventory based on the Roaring '20s, the music coming to an end, which I think this is exactly what we're seeing right now. Same kind of instance where the e-commerce boom that we saw during COVID, things like that are coming to an end, but people are stopping to buy because of inflation, all these things. But it's just kind of eerily similar to some of the economics that we saw back then. And just kind of seeing how, history does often look very similar to past instances. Obviously, we're in a different time, but I just thought it was sort of interesting.
Mm-hmm. Yeah, and I mean, you talked about like overvaluation of assets, and I think the U.S. has been kind of the de facto champion of massive overvaluation. And if you look, Europe, Southeast Asia, other places, there are a little bit less from a valuation standpoint of being so overburdened, but there's a lot of reasons for some of those other places that just haven't kept up. But the U.S. has been the place to invest over the past, 10 to 12 years. And yeah, you've seen a flood of capital there. And traditionally there's like this international US kind of trend of one will outperform for like 5 or 10 years and then the other one will. So we're kind of at that point where maybe there is a switch, or maybe there's just, another kind of lost decade. I think a lot of people that are US investors, and I can remember a conversation somewhat recently with someone that was talking to us like, I can conservatively get 12% just investing in the stock market. And it's like, yeah, I think people got lulled to sleep on like what returns actually are, because if you look from 2000 to 2009, it's a lost decade in the S&P, like annualized negative 1%. That was bookends, right? .com crash, great financial crisis. Okay, that's not great, but it's like, that's wild because that's in living memory for anyone that's really an investor, but it's just out of sight, out of mind. Like it's only 20% plus every year, and that's what people have now anchored to. And unfortunately, I think a lot of people might be disappointed as we start to see this kind of deglobalization and this deleveraging, where all of a sudden this free, easy capital flow starts to slow down. And again, like you said, I think we're kind of in the middle of the beginning of that. And the big trillion dollar question is: do you see higher inflation, or do you see this deflationary shock that just wrecks everything? And going back to some of the decisions from policymakers is, okay, if we want to stop inflation, we're going to raise interest rates, right, to curb that. But what happens if you raise interest rates and inflation still runs? Then you get a really, really, really difficult environment. So we'll see.
Yeah, so along the lines, I mean, I'm sure we have sort of differing opinions, but I think same opinion, maybe different ways of looking at it.
Sure.
But in terms of inflation going forward, sort of what do you see happening, and how is it going to affect investors, and how should investors sort of approach it? Given all these situations. Like, I mean, actually, I was just talking to my parents last night because they're, getting to retirement age and, are having the panic, as I'm sure many people in their late 60s are as well.
Yeah.
But so how do, young investors, old investors, et cetera, sort of approach the environment we're in today?
Yeah, well, you can basically have four environments. You can have higher inflation, lower inflation, growing economy, slowing economy. So high inflation, slowing economy, stagflation. I feel pretty confident. I can say that that's where we're at now. But yeah, I mean, most investors are positioned for where we've been the last 12 years. Last 12 years, it's been U.S. stocks, U.S. bonds, U.S. real estate, all have done awesome. So if you think, hey, the air maybe is getting sucked out of the room, perhaps you don't want to just be over leveraged and over focused there. What hasn't done well? So commodities, even though they've roared this year, still, if you look over a 5-10 year period, have a negative, return. Commodities do well in an inflationary environment. You can play commodities directly, but you can also look at different strategies or tactics where you can allocate to that. So one that we've liked and talked about has been managed futures, which is something that I think for the vast majority of investors is a tricky thing to own. It's an allocation you just want to have in the portfolio that can structurally do really well in an environment that you see strong trends. If it gets choppy, it can suck, and it can be really painful to hold. And you're like, why do I have this thing? But if you see strong trends, market down, commodities up, grains up, energies, metals, all that stuff, or bonds doing poorly, like it can make money in any strong trend. So I think that's one that the vast majority of investors don't own. I posted about that actually on Twitter, and a lot of people in kind of the FinTwit community, so other advisors, people that are allocators, really were like, oh, it's so impossible to own. And that was at the beginning of the year, and those things are up 30% since then. And still people are very, very under allocated, but they'll chase performance, and then it probably will not be as strong. But I think anything that you're going to own, you want to be able to have success in any environment. So you can have, high inflation, slowing growth. You can have accelerating growth and high inflation. That's like 2002 to 2007. That's kind of BRICS: Brazil, Russia, India, China. Then you can have the deflationary growth, which has been where we've been since 2009. And then the deflationary bust is everything hits the fan, 2008, February through April, COVID, and then kind of .com scenario. So I think the goal is you want something that's robust and resilient. So the name of the game is, where are you at and how are you going to allocate to that? And then the other thing being, is it inside money or outside money? And I think Arthur Hayes wrote a great piece called Energy Canceled earlier this year. It's fantastic, talking about outside money. commodities, gold, Bitcoin, those type of things are outside of the traditional system, again, they're still going to get impacted as we've seen, right? And we're not going to necessarily turn this into a Bitcoin and crypto podcast, but you've seen a lot of over leverage and massive speculation in those spaces where you're seeing people get absolutely wiped out. Big professional institutions that thought they were too smart for their own good are now absolutely wrecked. And that's good because there is no circuit breaker or stop loss there. So the idea is that you want to be able to have something that's as resilient as possible to survive. You don't have to outperform every single year. You need to survive. And I think that's the biggest thing at the moment is not having an allocation that's predicated on one environment. So again, hey, if we see low interest rates in a growing economy, I'm great, I'm gonna make a bunch of money. But if we see anything else, I'm not good. I think the idea is that you want to be able to be resilient in the face of something we don't know, because it's hard to say for sure, hey, we're gonna see higher inflation, or do we see this deflationary bust? I think we see higher inflation structurally, but I wouldn't want to say, hey, all my eggs are in that basket.
Yeah. No, I would agree. I think, if I'm pulling out my crystal ball here, I mean, basically kind of where I see inflation over the next several years is continuing to stay high. Obviously I think the Federal Reserve did a decent thing by bumping up interest rates 75 basis points the other day, but to start finally combating this. But at the same time, I think what's going to happen is I don't think we've actually seen the real fallout from the Russia-Ukraine conflict, because they're some of the biggest producers of fertilizer, they're some of the biggest producers of grain, and obviously they're some of the biggest producers of fuel, or oil. And oil is the backbone of transportation. If those costs go up, the cost of goods go up. Grains, that's one of the backbones of most food products. So you're going to see either transition to cheaper grains like corn and things in the U.S., which obviously have big health impacts and things like that. Like as a bunch of research has come out and said, so that's going to increase health costs. And there's all these kind of transitory things that come from those things. It's the same with like fertilizers. If there are less fertilizers, there's less crop yields, which increases food prices. We haven't seen these things happen yet because they haven't even gone through a summer of grain harvest yet where that's missing. They haven't gone through a summer of harvest where the fertilizers aren't as available. But as you see those things kind of pile up over the years, it's going to have a huge sort of transitory impact. And I think could be a several year thing. But I also sort of believe that I think the stagflation piece, I 100% agree that we're going to see some stagflation because we're going to have no growth because of just where we're at in the environment. But one of the things I think that will happen is I think the system's going to break so much because of this, and you're actually going to see some really innovative, people, systems, processes, things, and ideas come out of this. And that's one of the reasons that economies should correct, is because that's what breeds innovation and creativity is hard times. And I do think we will start to see a deflationary environment post, because you'll see some technologies like AI, quantum computing, things like that really have a strong hold on being able to just produce massive efficiencies in our world, which I think is really interesting. But I think we're years out from that. I think it's going to be some very hard years in between now and then. But in terms of like the investments, 100% agree on the managed futures. And something Isaiah and I talk about all the time is, if you want to build wealth, rule number one is minimize losses. Just because losses become exponential, and that's the hardest way to dig out of your hole. And a lot of people along the averages of the S&P, like, hey, I can just get 12% in the S&P 500. Yeah, but that's what everybody says. And everybody says, okay, let's just index, just keep costs low. Well, if you invest like the average, what are you going to be? You're going to be average. And
are you willing to see your wealth cut in half twice in your lifetime and go through periods of underperformance for 10 years? And the average person can't handle underperformance for 6 months.
Yeah. And I mean, even along that time, without going into, that's a whole different, I go on that for tangent for hours, but just, the underperformance and, if we look at the averages in the U.S. in terms of like the people that are indexing, the people that are doing the S&P 500, if everyone just stuck to the guns on that, everyone would be millionaires. Or in actuality, in the U.S., vast majority of people can't even, pay an emergency bill if it comes up. So obviously, the average way of investing does not work. I mean, it could, but you have humans in that mix, and that just doesn't work. So yeah, so building a resilient portfolio that minimizes losses and can perform differently than the average, that's where you're going to start seeing, really significant growth of your wealth, really significant protection in hard times like this. Like managed futures is a great one. We've talked like there's tail funds too that basically sort of hedge on the downside.
Another thing that's super hard to own, but when it works, you're like, oh, this is great.
Yeah, exactly. But I mean, I think even now, like aside from just assets that you can buy on the stock market, I'm a huge proponent now of like, if you're going to start a business or buy a business, now is the best time. Like you have a generation of baby boomers that are trying to retire and want out of their businesses. So there's a lot of cheap businesses for sale that you can buy with, government assistance through like SBA loans at relatively cheap rates that are much less than inflation. And you can, buy a business that has just ridiculous cash flow and really increase your lifestyle very quickly. And the nice thing too is you can innovate within that business, figure out how to operate through hard times, and next thing you know, you have a very resilient life. So there's and you have much more control over your life too. So I think there's just even things like that you can do that are just outside the normal box that are just, to me, fascinating. Or you could be, during these hard times, be one of those innovators that comes up with the next big idea to, save us from despair. But I think business ownership is an awesome tool. I mean, I think real estate, although the asset prices right now in real estate are just asinine, I think those will still be resilient long term, just because the supply and demand of just, there's a lot of people that need a place to live and there's not enough houses. But is it going to go through hard times over the next couple of years? Absolutely. But if you're trying to buy in those couple of years or ready to buy in those couple of years, you could have a buying opportunity of a generation. But that's I guess one last point on that is that hard times suck, obviously, but generational wealth for those that are prepared and not sitting on their laurels, just investing in the S&P 500, writing it down, those are the people that build generational wealth and that you hear about for generations. Like, I mean, one anecdote that I think is sort of fascinating too, but kind of circling back to the Great Depression, is the Kennedys. Well, the Kennedys' wealth was built during the Great Depression, and obviously that family has been, relatively well known over the past 100 years. Yeah. But basically, the story is that, like, essentially, I forget the exact Kennedy's name, but it was like JFK's grandfather. He basically was getting his shoe shined, and like he was a decent businessman, but like okay wealthy, like had a good lifestyle, but nothing like they are today. And the shoe shine boy was talking about what stocks to buy, and he was like, "Oh dear God!" Like if
it's the Uber driver of today.
Yeah, exactly. So he immediately went and sold everything and had all this dry tender during the crash, and basically just bought assets. And next thing you know, they're one of the wealthiest families in the country. And so, like, obviously not everyone's going to have that exact experience, but I think it's a nice story to be like, hey, this is why you prevent losses and be ready for these trying times, because that's when things go on sale.
Yeah, and I think one of the things he talks about is like the tech innovation and the deflationary piece. I'm going to go back to a little bit and encourage people, hey, read Jeff Booth's book, because it talks about that. But the challenge with that is technology is deflationary, and we have awesome technology. We've had awesome technology. The problem is the monetary units are created that cost $0, and that artificially is causing massive issues. And so if we continue to print and create more units, like the technology can never keep up. So like that's a structural issue that has to go away, which again is at the core of the thesis of returning to something that actually makes sense, that has a material cost to produce and sustain. The other thing you talked about is the idea that inflation might be higher for longer. And a person that I really enjoy listening to, not always like the most rosy, like you feel good after you listen to it, but Peter Zeihan, who is a geopolitical expert, he's the author of an upcoming book, The End of the World is Just the Beginning, Mapping the Collapse of Globalization, which sounds rosy as well. He was just on Ned Faber's podcast, who's a great financial podcast as well. It's episode 419, and he was asked for a non-consensus view. And his non-consensus view, and this has been within the last month, is that the U.S. inflation is the lowest level we'll see in the next 5 years. And it was like, wow. So many people do not agree with that, and so that's why it would be non-consensus. And yes, inflation's here, but it's like, oh well, it'll subside, right? And he's saying, no, there's some structural things that the kinks in the system don't work out very quickly. And so he lays out some thoughts. Now again, Peter has beliefs and thoughts that I completely disagree with, and plenty of people have really good thoughts in certain areas, but he's definitely one that's been spot on and talked and highlighted about, you know, a lot of the things that may happen with Russia years ago, right? And so he's called a lot of different places with what's going to happen, and has been very, very tied into that. And I think his research and his team do a great job. So to me, that's definitely an opinion that you kind of pay attention to. And then I don't think anyone's really prepared for that. And, you know, he's talked about a global famine in 2023 just because of some of the issues he talked about with Russia and Ukraine, crop yields, fertilizers, all those other things. Most people are not prepared for that. And I think one of the things where you can put on your tinfoil hat and be Mr. Doomsday is like, shoot, maybe you should just have more like food on hand and figure out to be a little bit more self-sustaining, or find ways to find your food locally versus trusting the supply chains of the, you know, mega, you know, big box stores. So those are things that are actionable, that are even outside of just the investment management piece, that I will continue to harp on. Worst case scenario is there, you eat through it, and no harm, no foul, right? Like it is very, very simple to do, and I think everyone should wake up and start thinking about that a little bit more.
Yeah, and as someone that's become an avid gardener, by no planning of my own, just my wife wanted to garden and decided she didn't want to do the work.
Yeah,
so
I mean,
I've gotten nerded out on it, but it's fun. I mean, if nothing else, you know, obviously it serves a valuable purpose in, you know, potentially these type of environments. But if nothing else, yeah, start a garden. It's fun. But yeah, I lost my train of thought. I was going to piggyback off one of the comments that you made.
High structural inflation in the next 5 years, deglobalization. What else does Peter think about? Global famine. All positive things.
Yeah, all positive things. Yeah, no, I just lost my train of thought.
Or deflationary environment. The last thing I would say, you made a comment that, again, we always will have just different opinions, which is fun, is the Federal Reserve is not doing a good job. They have never done a good job. And so the Federal Reserve is trying to take a handful of people and manage a very complex system. It's never worked. It will not work, has not worked. So they are trying to do something that is damn near impossible. And sure, can they try to do a better or worse job? But you can't have people managing a complex system, and you should just let the system naturally do what it's going to do versus trying to manipulate the money in the system. Like, let people get blown up when they do stupid things, and then let them wash out. Don't, you know, bail them out. It's the idea of, like, you know, I can't think of the quote. It's so good. I'm gonna kick myself and remember it later on. But it's basically like almost like the rules for thee but not for me type of thing, where it's, you know, oh, it's, you know, capitalism, but then socialize the losses. But then, you know, you're able to then compound on the fact that you're able to take advantage when you get, you know, bailed out, or able to not necessarily get the ramifications of bad decisions. And I think a lot of, you know, bigger finance has been able to do that over the course of, you know, the last 10 to 12 years, where they've been able to run businesses or run institutions that are not necessarily doing things that would make sense in an environment where they actually were punished for those decisions, versus being in a accommodative environment, which maybe that's starting to change. We will see. And I think that's the multi-trillion-dollar question, is like, what does, you know, interest rates and what does inflation do? Because that drives so much. When you have companies that aren't necessarily profitable, that are refinancing debt and rolling it over, and all of a sudden it's like, ooh, these interest payments are way higher than what they used to be. That's when things happen. And you've started to see layoffs, especially in the tech sector, it seems like, coming through. And last time you see those type of larger layoffs, it's not boded well for the future.
Yeah, exactly. And I remember my thought of sort of piggybacking off what the Fed is doing in terms of, and this, I guess, is a PSA for one of the things that could come and is likely going to come as part of this whole inflationary mess, which would also cause inflation in a way for a lot of people, and something that investors should prepare for, and this, especially, I think, people that are going to retire in the not too distant future, and actually, well, I guess millennials as well. But the way out of inflation, and kind of two systems that I think are going to change drastically because of the environment we're in, from like a you know, just environment perspective, is one of the only ways to combat inflation outside of raising and tweaking interest rates is increasing taxes. That's the whole kind of philosophy of modern monetary theory that also says we can print all this money, right? So you see Janet Yellen out there right now trying to raise corporate taxes all over the world. Well, again, all these increases in taxes have a transitory effect on you as an investor, where as tax rates go up for corporations, they're going to pass the buck to you, especially if they're already tight with money from their supply chain and things like that. But also, it's going to be not a far step off, and we're already seeing it with the Green Book from Biden, where personal taxes are going to be the next thing on the target, and especially for like retirees. There's trillions of dollars sitting in 401ks untaxed, and so things like RMD changes are most likely going to happen. Estate tax laws are going to change. Income tax rates, wealth tax, all these different things are going to start. You're going to start seeing potentially out of necessity. So, trying to find ways to minimize your tax burden long term, I think is going to be, aside from just the investing standpoint, that's going to be a very crucial thing. And that's circling back to the kind of business idea and things like that. Looking for investments that can kind of kill two birds with one stone, I think is also going to be a way for you as an investor to protect yourself from things that could come. Obviously, we have no way of knowing where the tax things are going to end up, but I think it's just an interesting note in that as taxes go up, obviously that just means less money for you to go buy goods that are now more expensive, and so it's just something to definitely account for.
Yeah, and the idea that stimulus money or gas cards or these other things are going to help with inflation. No, that's the whole reason that we're in this mess, is that it's been free and easy money. So doing more of that is not going to help. So anyone that thinks like, hey, I'm going to give this gas card because gas is expensive, that doesn't solve the issue. Like, you can't create more money for like hard goods. If I give you a $100 gas card, does that allow a oil and gas company to tap a new well that won't be functional for 5 years? No. Like, there's just things that don't make sense. Does that help crop yields? No. Like, it just doesn't compute. And you have people that are seemingly, like, you hope that they're like joking at times. Like the same thing with taxing unrealized gains. Like, what? Like, structurally, how are you going to do that? Like, the IRS has so many problems with trying to keep up with just what is currently the tax regime that we have. It's like, if you make all those changes, there's just not the manpower to make it happen. So it's
plus
wild.
You're going to see if
mass exodus of people from this country.
Yeah, I can tell you right now, I'll be moving to Puerto Rico or something if that happens. But
yeah, it's ridiculous.
But on that rosy note, any final parting words of wisdom for listeners?
Yeah, I think it's just trying to say, how do I have assets that don't suffer from losing purchasing power over time to inflation? And I think, going back to your comment about, older generations or anyone, and we talked a little bit about robo in the past, fixed income to me, so bonds in general, is a place where money is going to go to die in real terms as far as purchasing power. And I continue to see the buy and hold index crowd like Trump that say, hey, just continue to buy. This is good for long-term bond investors. It's like, no, you're literally wiping out, money for the future by owning that. It's like, you can find diversifiers outside of just bonds for your stock portfolio. And I think that's what I would encourage people to look at, is if we see structural higher inflation and rising interest rates, bonds will continue to get crushed. And so, do you want to own them? Sure, but I think you need to own them in a different way than just, hey, I'm going to plug my nose and buy and hold this forever.
Yep, absolutely agree. And actually, circling back real quick before my parting thoughts, one of the other structural things I forgot to mention was Social Security. Obviously, there's already stress in the system.
Definition of a Ponzi scheme, by the way.
Yeah. We could do a whole other podcast on that, but we're definitely going to see, I think, the disappearance for anyone past a certain age.
We're not seeing it.
Yeah, call on age 50 or so, something like that. Like, you're not going to see Social Security, Medicare for anyone below the age of 50, I think, as of today. And so, yeah, we're not getting Social Security, and if you're a millennial listening to this, you're not getting Social Security. So, the self-reliance kind of motto here, like, take care of your own. That's why we believe in work optional instead of retirement, is because, if we don't have these systems to rely on, well, then we need to rely on ourselves. And then why are we hamstringed to a 65 retirement age if we don't have to? We can work if we want, or retire if we want, or a mix of both. Retire for a couple of years, or take a long sabbatical and go back to work. Whatever suits your boat, or floats your boat. And so, so that's another thing I think is going to break with the system, and just something kind of a reminder of, hey, we gotta look out for ourselves, one way or another. But anyways, yeah. So I think inflation's definitely going to be here to stay for the foreseeable future. So if you're an investor out there, this is a risk that you don't want to forget about. Volatility, I think, is not the biggest risk at the moment. It is going to be purely just the depletion of the dollar, and really having a portfolio and assets that combat that are going to serve you super well over the next coming decades.
And fixed interest rate debt in an inflationary environment is not a bad thing. So mortgage, car payments, all those things you don't need to rush to pay off, because those continue to get cheaper and cheaper. So I guess I should think that's a better closing thought than
Don't listen to Dave Ramsey.
Yeah, Dave Ramsey, he just said the other day, well, actually, I'm going to say that for another podcast of what he said the other day, because I don't want to open up that can of worms. But yeah, inflation's here. Think about ways to, you need to have the emergency fund on hand, but that cash is losing purchasing power over time. And so you have to find a way to deploy that in something that, is going to be able to maintain or protect purchasing power in the future. I think that is the biggest thing this decade, is trying to maintain purchasing power for the value that someone creates.
Yep. And if you do that, we're confident that you'll be in a position to build generational wealth because of the opportunities that'll come.
Absolutely.
But until next time, on that rosy note, cheers.
Cheers.